G'day folks, we're looking at the Aussie US dollar today. Now they're in long positions on the charts, on the daily at least. We'll go through that in a minute with some back testing. Before you go any further, make sure you hit that like and subscribe button to support the channel. Now in terms of the outlook as of today, October 2nd, the Aussie US is supported by a narrowing interest rate gap. RBA holds at 3.6%, while the Fed has cut to 4.25%, weakening the US dollar. Australia's sticky 3% inflation and steady commodity demand add modest upside for the Aussie dollar, though slower growth temper hawkish expectations. In contrast, US inflation and Fed rate cuts weigh on the dollar, while global risk sentiment and export strength further underpin the Aussie dollar. Don't forget to reference the +1 videos to get a deeper dive into some of our trading strategies. So we always look at the weekly chart first on the left here, and you see the price is well above the moving averages on the weekly. We had a bit of a dip into the CCI 150 back there around about July, August, but it's broken up above that as well. So going long, if you go trading on the daily, we go in a direction of the weekly time frame. So going long at the moment, according to the weekly. On the daily, that's also just a fresh breakout to the upside above the moving average on the price and also the CCI. Now, because the price moving averages are still in a bit of an uptrend, you can start going long in accordance with that. If it was the other way around with the fresh breakout with the moving average on the CCI going up and the price moving averages going down, then obviously you don't go long. It's probably a lot more dangerous that way. Back here we had a bearish divergence, almost a double top or a triple top on the CCI versus higher highs on the price, and that dropped down, hit our 23-38% target range, and that 23-38% range, if we take it back to that significant low before that divergence started, is at 23-38% Fibonacci. You can see there it hit that range, bounced, hit it again, and then it bounced finally a bit, moved further to the upside. Now that's the daily, and there's no divergence at the moment where we are at the moment. Back here we had a very small bullish divergence, and that bounced quite strongly. And these very narrow ones often, just a bit of a tip, these narrow ones really have a lot more stronger impulsive moves to the other way. Back here we had another bullish divergence, and that also hit our 23-38% target range, and then it bounced further to the downside before recovering. So that's the daily. If we go to the hourly, remember if you're trading on the hourly, we go in the direction of the daily. So and I'll show you that in the back test in a moment. So on the hourly, working backwards, what we're trying to see is any divergence, and you can see lower highs on the CCI there, and probably a divergence there, a double top there, but I would call that a very similar sort of price movement with the CCI. So I won't mark that as a divergence, although that could possibly be a divergence considering those peaks on the CCI. There was a bullish divergence back here that broke up well above the 23-38% target range Fibonacci. That was 100%, and that one bounced up to the 100% retrace level. There was another bullish divergence there that hit the 23-38% range. And back here we had a bearish divergence that broke down, hit our 23 and actually fell further. Now this one here, we drew a target range, would have taken it back to that level. There's another bearish divergence there as well. So looking at the back test, again going long from that period, that was around about the 28th of August. So that was around about this period there when the price broke above the moving average, and so did the CCI. Now notice here the price moving averages are bending upwards and moving upwards straight after those little bit of a consolidation there, and the CCI broke already above the moving average band, so you would have gone long from around that period there. And again, what you're doing here is a couple of stop loss scenarios. On the very latest, you get out of the daily when the CCI touches the moving average band. At one point there's another point there to get out of that trade. Now you'll notice at each of those points, if you followed the hourly chart, if you're trading on the hourly, you would have got out of those long trades. So when the moving average of the price and the moving average of the CCI are moving up, you get out when both the CCI and the price moving averages start to bend down. So you would have got out of that trade there. And in fact, that point there, you didn't have any contracts open anyway. Open another couple of contracts there, close it out there, open another one. Now here you had a bearish divergence. And as soon as you start seeing a bearish divergence, lower highs there, that was the first point there. You may want to start taking your profits off the table and get out of the trade. In this case, you wait for the price to break below as well as the CCI, and you would have got out there. So you would have been holding a couple of contracts there with a bit of a loss, but nothing too dramatic because you would have made it up during that little period. Going long again there, get out of the long trades during a bit of a decline, and then go long again there. And here we had another bearish divergence. at the very latest, you would have got out at that point and avoid this drawdown. So you would not have been in a long position during that period there. So make sure you hit that like and subscribe button. And if you enjoy the content, subscribe at least on the free trial to the Patreon page where I publish weekly bullish shares. Thanks for watching and see you in our next video.